Let's say you've saved $10,000 above your needs and reserves and would like to invest it. You've been reading glowing reports about the future of small computers, and your cousin Bob assures you that Apandi, the microcomputer company he works for, has an excellent chance for growth and profit. How do you find out more about Apandi and go about buying stock in the company? You could just go downtown and visit your local stockbroker. But before you go, check the business section of the newspaper, or even drop by the library. If you find Apandi on one of the stock lists in the newspaper, you'll know it is a publicly held company, as well as the price of that stock the day before. Also, which list Apandi appears on will indicate which security exchange trades the stock. You've heard of some major security exchanges. Which do you think is the largest? Yes. Large companies are likely to be listed on the New York Stock Exchange, and smaller companies on the American Stock Exchange, or the 14 regional exchanges like the Boston, Midwest, or Pacific exchanges. The stock of many small companies is not listed on any organized exchange, but is handled independently by brokers over the counter, and may appear on the OTC lists in the newspaper. Even if you don't find Apandi in the newspaper, don't assume it is privately owned and its stock is not traded. Your newspaper's lists may be incomplete, or Apandi, like Radio Shack or Atari, may not have stock in its own name because it is a division of a larger company. Your next step might be a trip to the library. What do you suppose you would look for there? Right. Moody's and Standard & Poor's both publish manuals that give historical facts and financial information on thousands of companies. Your library probably also subscribes to various financial newspapers and magazines. It may even have copies of reports Apandi sends to its stockholders. While you can buy shares of a company directly from a shareholder, you probably don't know anyone with the right number of shares who wants to sell them at the current price. So you go to a broker. Where would your broker probably get 100 shares of IBM Corporation stock for you? Yes. Your broker would have to arrange the purchase through a member of the New York Stock Exchange. The brokerage firm would have to own a membership or make arrangements through an independent member. Each of the 1,366 memberships, or seats, on the New York Stock Exchange may be worth $100,000 or more. The New York Stock Exchange lists more than 2,000 stocks and 2,000 bonds, and handles about 60% of all share trades. To be listed on the New York Stock Exchange, companies must have at least 2,000 shareholders with 100 shares each, and have shares with a total market value of $16 million, as well as meet other requirements. Apandi doesn't quite meet them. Where might it be listed? Good. The American Stock Exchange lists about 1,000 stocks and has more lenient listing requirements. The 14 regional exchanges have even more lenient listing requirements. A penny may not be listed on any of the organized exchanges. The vast and rapid communications networks in the United States make it possible for brokerage firms to trade the stocks of a large number of small firms without an actual marketplace. What is this called? Right. The over-the-counter market, which handles about 25% of all share trades, is connected by the National Association of Security Dealers Automated Quotation System, the NASDAQ. This system provides many current bid and ask prices, which are the prices at which brokers will buy and sell stocks, and allows buyers and sellers to locate each other. Buying and selling stocks used to be a rather unregulated process. But in 1933, 4 years after the 1929 stock market crash, the Securities and Exchange Commission, the SEC, was established to regulate the stock markets and ensure that the important operational and financial facts about companies were disclosed. Also, most states have blue sky laws regulating securities sales within state borders. These laws make sure that companies do not attempt to sell investors nothing but blue sky. What are the initials of the Federal Commission regulating securities and exchanges?
Sorry.
Right. Stockbrokers and the firms they work for are licensed by the states and by the exchange on which they buy and sell stocks and bonds. Big firms like Merrill Lynch, Pierce, Fenner & Smith, Bosch, Halsey, Stewart, Payne, Weber, Jackson & Curtis, and E.F. Hutton have branches in many cities. Most stockbrokers are more than salesmen. They are account executives who provide investment advice. As with your doctor or lawyer, it's good to establish a relationship of reciprocal confidence and trust with your stockbroker. What's the first name of the biggest stock brokerage firm?
Fucker.
Brokers, like lawyers or doctors, make money only when they can do something for you. Brokers get paid a commission of about 2% when you buy or sell securities. For this reason, your broker may be tempted to overtrade, which is called churning. This may generate some profits for you, but over the long term it may be expensive because every time your broker buys or sells securities for your account, he charges you what? Yes. Most brokers, of course, want to keep your business and will try to advise you wisely, based on their understanding of your individual circumstances. What is another word for overtrading?
Right. Brokers often provide research analysis of markets, industries, and individual firms. The bigger brokerage offices have electronic displays of current stock prices and late world news. This information appears on quotation boards on the walls and on individual desktop computer terminals. When you buy stocks or bonds, you may have the certificates issued in your name, or you may have them held in street name, which means they are held in the name of the firm, in its safe, and insured. Having them held in street name allows you to sell them with just a telephone call. The stock quotations in the newspaper show that shares can be any price, but most are between $10 and $100 each. You don't usually buy just one or a few shares, however. Your broker's fee is usually less per share when you buy in hundreds of shares, called round lots. If you want to sell securities with just a phone call, how should you have them held? The broker's fees for a stock transaction may be about 2%, sometimes less, but often more if the amount of stock is small. 2% is not much, but it is 2 months' interest on your money at a 12% per annum rate. There are discount brokers available, and if you don't need special services, a discount broker may save you money. If General Motors shares cost $50 per share, how much would one round lot cost? When you place a market order, you instruct your broker to buy or sell stock at whatever the market price is at the time. When you place a limit order, you instruct him to buy or sell when the price reaches a certain amount. A stop-loss order is an order to sell if the price drops below a certain amount. You instruct your broker to buy 100 shares of ABC, now at $31, if it drops to $30. What kind of an order is this? Yes. The limit order is a slightly more complex transaction than a simple market order. The limit order to buy at just below the current price takes advantage of the normal fluctuations in price and may, in effect, save the cost of the broker's commission, but it runs the risk of not being filled. Most security transactions are long. The security is bought at low price and held until its price has increased. But you can go short if you think the price is likely to drop. Your broker borrows the security for you and sells it at the current price. If the security's price then drops, you buy it at the cheaper price and return it to the lender. When you sell short, what do you do? Right. This short selling may seem a little dishonest, but it's perfectly proper, although not as common as long transactions. When you borrow the stock, you put up its current price, and you don't receive the money that the stock is sold for immediately. So the stock brokerage firm has considerable protection if the price should rise. If the price of the stock behaves as you hoped and drops after your short sale, you buy the number of shares that you have borrowed and sold. How do you make a profit from your transaction? Yes. Selling short is more risky than long transactions because stock you sold at $10,000 might cost $100,000 to replace. Another transaction with more risk is called buying on margin. It involves borrowing part of the amount you need to make a purchase. If you felt that a pandy was going to double in price and you had only $10,000, you might be able to borrow another $10,000 from your broker for $20,000 of these shares. Then, if the price doubled, you'd make $20,000 profit instead of $10,000. This kind of transaction is called buying on what? Yes. Purchases of stock on margin require your broker's approval and minimum deposits, and they must meet federal requirements. As you can see, margin transactions are more speculative than many investments. Once you own shares in your name, you are a shareholder or stockholder, and once a year you will get an annual shareholders report, often very artistic. Besides slick, colorful pictures of Cadillacs, what would you expect to see in a GM annual report? Right. Most companies send quarterly financial reports too. Meanwhile, you can get more current information by reading the business sections of your newspaper or financial newspapers like Barron's or the Wall Street Journal. There is another kind of corporate or government security which fluctuates in price too, although generally not as much as stocks. The papers also list quotations of these securities, price and yield, or periodic payments. What kind of security is this? There is always a lot of information available about the economy, about business, and about the stock market in general. There is also information about your company. You own part of it when you own stock, and the particular industry it represents. One year, your company's report might show its net worth, assets less liabilities, per share is $40. But the next year, its net worth per share might be $38. What would you guess might cause this change? But your stock might have sold for $50 per share when the net worth per share was only $40, and sold for only $30 when the net worth per share was $38. Stock prices are largely an indication of investors' confidence in a company's future earnings. The PE, which you can find listed in the newspaper, is the price-earnings ratio, the stock price divided by current annual earnings. A high PE indicates that investors are confident the company's earnings will increase. You will find, as soon as you become a shareholder and start reading the financial news, there is no lack of investment advice and advisors. Some are free, some expensive. Some are valuable, some worthless. The expensive advice, moreover, is not always the most valuable. You will be pleased to hear that your stock is going up and paying more dividends. You will be sorry to hear that it's down. The value of your investment is what you can get for it in the market. When do you really take your profit or loss? If your security becomes more valuable and you sell it after owning it for a year, your profit from the sale has an income tax advantage over interest earned on a savings account. What is this?
That's stupid.
Investing in securities, is investing in the capital of American industry, which is the heart of our economy.